We will now transition, thanks very much, Rama. We'll now transition to the first panel. And the setup for this panel is the public sector and the private sector role in infrastructure and goes beyond financing, but of course includes that. Part of the thing with this particular panel, and Henry, would you like to come on? He's the moderator from Sciens Water. Please welcome Henry. Yeah. Part of the thing with this panel is to actually amplify and think about the things Rama brought up and Peter. But later in the day, we have a panel also on water insecurity, which is focused to some extent, at least, on disadvantaged communities, poorer communities. How do you actually create affordability? And so that's part of the role. So Henry is with Sciens Water, and he's going to be the moderator for this group. Could the panelists also come up, please? Wait. Hi. Yeah, go ahead. Maybe you can start off and then quickly have people do a short self.
Yeah, hi. Can everyone hear me? Yep. Welcome everyone to Rethinking Water. We're very proud to be, as Sciens Water, a sponsor of this event. Sciens Water is a New York-based private equity firm investing exclusively in the water sector in the US. We invest in water infrastructure and infrastructure services companies, so companies that provide services to those infrastructure assets. And for us, what we really focus on in bringing finance to the water sector is how can we create conduits of private capital to come into the sector, which we know is heavily financed today by public sources of capital. So how can we facilitate private capital going in as well to support that? I think a recent report from McKinsey noted, $100 billion annual funding gap for water infrastructure in the US to today. So how can we kind of bridge that gap? And I think for the panelists today, I think bring a lot of different interesting perspectives from the federal level, from municipal finance. Obviously, we bring the private part of it. So hopefully we can have a good discussion on, I think, how can we first identify, how is our infrastructure being financed today in the US? Where is that working well? Where are there gaps? And maybe work on thinking about some solutions to filling those gaps. So with that, I'd like to introduce the panelists today. If maybe you just want to go down the line, we'll start. And I think as you introduce yourself, I think it'd be helpful for the audience to say, what types of infrastructure are you involved with from a financing perspective? What is the state of that infrastructure? And how is that infrastructure being financed today? I think it kind of sets the stage for the discussion.
Great. There we go. Great. My name is Tyler Old. I am an infrastructure banker at JP Morgan. I focus on the public side. So my clients are pretty much all public water districts, government agencies. I mean, here in Arizona, so like City of Phoenix or Salt River Project would be examples. And so what I do is work with these public agencies to finance their capital projects, their infrastructure. I spend most of my time in and around environmental utilities and public power. So water, wastewater, public power in the western part of the United States. Most of that infrastructure is financed in the US municipal bond market, tax-exempt bond market. It's about a $3 trillion market. Very, very deep pool of cost-effective capital. And so for the public sector who has access to tax-exempt bonds and access to that market, it does provide a reasonably efficient means for financing most capital projects. There are segments of the market that don't have access necessarily to cost-effective tax-exempt debt. And that's an area where, we're focused, trying to make it more efficient for some of these. It's mostly smaller, some of the underserved communities to have access to kind of the same type of cost-effective financing that a larger public agency like a Salt River has.
Good morning, everybody. My name is David Palumbo. I'm currently the acting commissioner for the Bureau of Reclamation. Prior to that, in my normal day job for the last 10 years, is the deputy commissioner for operations. For those of you who don't know about the Bureau of Reclamation, we're the largest wholesaler of water in the United States, the second largest producer of hydropower. We operate principally in the 17 western states, those western states beyond the 100th meridian, if you've heard that phrase before, where water scarcity is just fundamental to our operations. With respect to financing of large-scale infrastructure, so we were established in 1902. Think of the All-American Canal, think of Hoover Dam, think of Grand Coulee Dam, and all the infrastructure in the West. So originally, our infrastructure was financed through federal appropriations, either mandatory appropriations, permanent appropriations, or discretionary appropriations, all coming from the American taxpayer. More recently, the last 20 years or so, the portfolio mix is a little bit different. We have instituted cost share agreements with a variety of different water users, those off-takers of either water or power, and incorporate investment. Really, what I like to think of is in a P4 arrangement, a private public partnership, in that we have cost share requirements at large infrastructure facilities where a local or municipal water authority will seek financing either in the public sector or the private sector, bring that financing together in a cost sharing agreement, where then we use some appropriations where we can derive federal benefits, and then the balance of the funding is used by that local municipal water authority after the investment is made. So just I'll throw out a good example. There's an ongoing project in Northern California, Sciens Reservoir. We're investing 16% of federal funding into that project. The balance of the funding is coming from a variety of different stakeholders, some of which are seeking their financing through private investment. Some are seeking their investment through public means. So it's quite a mix and quite varied today, and it's very site specific, and also it's very much a function of the interest and project purposes that might be derived from that particular investment. So look forward to the discussion here this morning.
Thanks. Thanks, Manu and Jay, for inviting me to come up today. I appreciate that. My name's Dave Wagner. I'm from a town down the road a piece called Tucson. I am kind of the strange person in this group in that I'm not directly involved in handing out money to anybody. But what I have done is I'm the science kind of part of this panel, I think. I've spent most of my career, and I was talking to Dave beforehand, started in 1974 in a lovely little town in central Utah called Duchesne, figuring out fill for building Current Creek Dam for the Central Utah project. So I've got a long history in starting at the very bottom and working my way all the way through the process. Currently, I work with part-time with Wolpert Engineering, where I help people try to figure out how are we going to manage water in the future. So looking at climate change and what are the tools and such that we need to. For part of my career, I was privileged to serve in the House of Representatives in the, both on the Natural Resources Committee, where I dealt with your reclamation, water policy and authorizations, and on the T&I, Transportation and Infrastructure Committee, where I dealt with EPA and the Corps of Engineers. And we stood up in 2014 the WIFIA program, which has led to investing in water infrastructure across the nation. I think my perspective on this is I come at this from the public policy side of things. I have worked with several people on getting WIFIA loans, et cetera, clients, but I want to figure out how do we make it work? How do we make it work better? Where are the gaps? Where are the holes? Where's the data we're missing? I'm the numbers guy. How do we make this pencil out? So it's a good investment, not only for the investor, whoever that may be, but also for the American public. So we can see that there is value moving forward. I would say when the Bureau of Reclamation started up the then Title 16 program in 1992, they were trying to focus on the smaller water people who had kind of been left out in the bipartisan infrastructure law. Now we're able to give you some tools to look at investing in larger water infrastructure projects. And we want to make sure those investments are good investments. So I'm here to talk about those issues today.
Thank you for the introductions. Tyler, I'm going to start with you. You said, I think money is not an issue. We got projects can be financed. We see an abundance of capital. So everything should be fixed, right? So what are the challenges that you see for that to happen?
Yeah, no, that's a good question. I do think in terms of just capital availability for most of the public sector, there is no shortage of capital. As I said, it's the muni bond market's a $4 trillion market. There's a deep pool of investors who participate in that, and so it is readily available. And there's a pipeline of projects too. There's a lot of projects that these agencies are looking at, whether that's your kind of standard repair and rehabilitation, or some of the bigger mega projects like sites, for example, or we're spending a lot of time in advanced wastewater treatment and recycled water, especially in California. They're $3 billion plus projects kind of in that space for water resiliency. I think one of the big challenges that is becoming increasingly acute in the public sector is affordability. And affordability it comes up at every single board meeting. Every time these water managers are meeting with constituents or ratepayers, the topic of affordability is coming up more and more and more. The credit rating agencies who assign credit ratings to the bonds that we issue into the marketplace, part of their evaluation and analysis of a particular bond offering is they look at the affordability within the service area. And so that is becoming more and more of a challenge. And actually, I think it is preventing some of these projects from moving forward as quickly as they should or could. So that's an area that we're very focused on, is affordability.
David Wigner, you've worked on a number of really interesting initiatives at the federal level to help bring in capital to the water sector, and maybe talk a bit about those, and then how you've worked to deal with this affordability issue that Tyler mentioned.
Happy to. I think from a policy level, my first effort was looking at primarily through big water projects. So Central Utah project in particular, Glen Canyon Dam, Colorado River issues. So we got a sense there of what the original intent was of developing water supply for a region. And towards that end, I think it's real important as we sit here today, we're challenged by the lack of water in the system. Now, whether it's, however you want to characterize it, we're seeing less water available for the 40+ million people who depend upon the water supply of the Colorado River system. So we got to figure out either how to make more water, which is a little difficult, or how to manage it better. And I think what we found is that historically, while the Bureau has done a great job of developing water supply for irrigation and for developing for hydro, et cetera, that there was some gaps in the process. Corps of Engineers is here in the West, but they're primarily flood control. You know, they don't really have the authority to do water supply. Congress has tried to change that a little bit with some legislation. My role when I was in Washington, D.C., as I mentioned earlier, was to help stand up the WIFIA program within the Water Resource Reform Development Act of 2014 and set up two programs, one for EPA and one for the Corps of Engineers. The EPA got a little bit faster start, and today that they've issued over 140 loans, totaling almost $22 billion in credit assistance, primarily focused on looking at creating jobs, but helping small wastewater plants develop water plans, look at supply and resiliency in hopes that we can start to fill some of these gaps that traditionally have not been filled. The Corps is recently stood up very effectively their program, but their WIFIA program is primarily looking at dam safety. They've got some legislation to allow them to do levee safety, but so far it's been dam safety. And they've looked at 77 dams across 12 states. So looking at how do we keep our existing infrastructure stable and safe so we can continue to operate it into the future. The Bureau's, what was originally the Title 16 program, has been a great program in the 17 Western states in that the original focus was for these small water users who didn't necessarily have access to the big water development projects like the Central Utah project or the Central Arizona project, had the ability to come in and start developing specifically. Now, that's come, and they've done, over 50 projects through the Title 16 program. It's now kind of morphed into the Water Smart program, so it's got a little bit more capacity. And in the bipartisan infrastructure law, they're actually now being allowed to and directed to help develop bigger water infrastructure throughout the Western United States, primarily focused on reuse and recycling. So it's, again, a great opportunity to make these drops of water go a little bit further. Affordability, it's a huge issue. We see it here in Arizona. There are a lot of communities along our border that they don't have the administrative ability to manage water, the colonias in particular, tribal nations, et cetera. There are some gaps out there. So one of the things that we're trying to do is figure out how can we make water affordable. It's hard to pencil out developing water supply for a small community. You don't have enough tax base to spread that across. So I'm also serve on an EPA advisory committee, the Environmental Finance Advisory Board. We've just completed a report in January that looks at this issue in terms of rate structure, in terms of authorizations, in terms of how do we make sure that the people are not left behind as we continue to develop the water, but the water gets more expensive. How do we manage these last drops?
Maybe if I could just jump in, because I think the WIFIA program is a really good tool to think about helping with affordability, because it addresses, and WIFIA will finance up to 49% of a water project. The other 51% needs to be the local match. But what's really unique about the WIFIA program and what has been helpful is because it's actually a little bit more expensive than a tax-exempt municipal bond financing. But what's helpful is it's flexible and it hits a part of the market where there isn't a deep pool of kind of public institutional capital, because the WIFIA program, their repayment period is significantly longer than what most institutional investors are accustomed to buying. And so when we pair a public securities issuance with a WIFIA loan, we're able to amortize the cost of these large and increasingly more expensive projects over a longer period of time. Thereby, when we think about how much of that annual repayment is getting pushed down and spread across the rate base, it's a lower amount every year. And so, being able to access different pools of capital to, extend the repayment, because these are long, the useful life of these assets is longer than 30 years, which is kind of the term of our market. And WIFIA picks up that back end. And so, on an aggregate basis, it can provide a much more when we think about annual affordability, a more affordable cost of capital. So it's been a great program.
David Palumbo, you mentioned something interesting in your introduction, P4s. Maybe you can explain what that is a little more detail and how effective you've found that model to be, because I think and I think how scalable is that model, do you think, in applying it to other projects?
Thanks a lot. Thanks for the question. Maybe I'll start off with the supply and demand imbalance situation and the tools that we have to bring into equilibrium that supply and demand imbalance. And there's three major categories that I like to think of: augmentation, storage and conveyance, and then conservation mechanisms. We'll maybe address the major rehabilitation and replacement piece, but P4 can fit in all of those type of arrangements. Again, it's a public-public private partnership where we move forward with a project. I won't use sites again, but maybe look at a project that we constructed about 15 years ago in Southern California, a large reservoir system to capture what was normally non-storable flows that would flow in excess to Mexico. So we constructed this reservoir and we sought investment for that funding from the local water users. And so the Central Arizona Water Conservation District, the Metropolitan Water District of Southern California, and the Southern Nevada Water Authority all put in the capital through their own means to invest in that project. They sought that capital either locally through private entities or, again, through their rate base. And they brought that capital forward, and in exchange for that capital investment, they received for a 20-year period the conservation of that water. So their return on investment back to each of those three municipal water districts was actual conserved water in Lake Mead that then they can use to augment their supplies. So that's one example, and there are dozens of those type of arrangements out there that, again, bring forward where the federal taxpayer either pays zero or a fraction of the cost of capital. The other public entities bring forward their capital, and we partner together to implement a project that has benefits for the funders, and that's where the return comes from.
Sorry, so we talked about some of the areas that are getting capital, areas that you see today that are still lacking capital. Can you maybe talk about those? Maybe I'll start with you, Tyler.
Yeah, I mean, I think a lot of the places where we see challenges are, again, some of the smaller systems, more rural systems. They don't have the rate base to support the capital cost for the projects that they need to do. And unfortunately, what's happening is just the deferred maintenance in some of these water districts is just continuing to grow. And especially in California, which is where I do spend most of my time. I mean, it's the whole central, it's very fragmented. I mean, there are, I don't know the exact number, but maybe it's 500 water districts in California, probably more. And they're all, there's this, they all have their own governing board. The idea of local control is something that's very important. But what happens is it prevents or there's significant resistance to potential consolidation among multiple regional water systems, which would be helpful as we think about this deferred maintenance that needs to get funded and spreading that cost perhaps more efficiently over a larger rate base. So that's a challenge. And that's an area that is going to need continued investment and in some ways probably subsidized investment. So, is that leveraging more out of the state revolving funds? Maybe, but those those are increasingly capacity constrained as well. And so, finding the capital for those systems is a challenge because it's difficult to rate base all of that at an acceptable level of return, certainly for the private sector.
David, for you, where are you seeing gaps in your funding needs?
Maybe I'll springboard off Tyler. So it's in that deferred maintenance, what we would call major rehabilitation and replacement. So as you cited, that the average life of this infrastructure that we have, major water infrastructure, call it 75 years plus or minus 25 years. And so a lot of that design life is coming due. And with major rehabilitation and replacement and overlaying the affordability of water on top of that is a major challenge. A lot of times, we can have a whole conversation about the true cost of water, but over time, the major rehabilitation and replacement funding is not collected. So when the need arises, you need to find that capital in full from elsewhere to make that investment into the replacement of the infrastructure, whether it's due to a catastrophic failure that occurs or just ending the design life and you want to bring it to closure in a responsible way. That funding is the challenge, and that's where the need for looking at subsidizing that major rehabilitation replacement comes in, or figuring out different mechanisms in which the investment can be made and the return can be provided, whether it's private or public, in a way that has a period of return that's not expansive, where it's going to attract investors. And that's where a significant challenge is, at least with the infrastructure that we're working in and the type of capital, the hundreds of millions of dollars, the billions of dollars that it'll take to replace.
Thanks. David Wagner, what do you think on the gaps?
I'm going to do a little bit of history here. In the 1970s, as the nation passed the Clean Water Act, the federal government invested in about 75% of water infrastructure. By the 1980s, that had dropped to about 63%. So we had seen a drop. Today, it's around, before the Infrastructure Act passed, it's around 4%. There's a gap, 4%. So who picks that up? Who picks up it's the states, and it's the local communities, institutions, et cetera, who have had to pick this up. Last Tuesday, March 11th, there was a hearing in Washington, D.C. I was back for by the T&I, Transportation Infrastructure Committee, on water infrastructure financing. And there were multiple gaps that were identified. Not to hard figure out the first one. Everybody's going to pile on. It's government mandates. It's the cost of permitting. It's the timing. It's the length of time it takes to get to the procurement requirements, et cetera. Granted, there are some issues with the government, and there's reasons on both sides of that argument why the government has gotten more and more involved in the agency's business. We don't need to go there right now, but David hit the nail on the head. It's the life cycle asset management. We need to look at these assets from their very beginning all the way through their ending. And whether that ending is replacement or removal, we still need to look at it as a complete life cycle analysis. So the key is that we have a lot of people who are not able to afford the new infrastructure because we don't have the federal government as a backbone on it. The federal and the local and state people don't necessarily have the checkbook or the tax base to do it. When you're out here in a smaller state like Arizona, it's not like you're back east where you've got a lot of people to spread these issues out to. What came out last week is everybody, to a person, care what side of the aisle you were on, they all said we need more federal investment. We need to stand up more money into the WIFIA programs. We need to stand up more money into the Title 16 programs, et cetera. So there is a desire. And why do people want the federal government involved? Well, you guys in the investment industry, there's a little bit less risk if you have the federal people looking into it. The problem is our SRFs, our WIFIA programs, they're oversubscribed. There are more people who want access to that money than there's money available to. The other problem that's come up is everybody's heard about these things called earmarks. You know, where a particular congressman or a senator goes in, identifies a specific project, gets it authorized, make sure it gets appropriated money. The problem is, once you earmark something, that money usually comes out of somebody else's program. There's not a bunch more money that's being printed, in spite of what Mr. Musk seems to think. But that issue is big, and we need to deal with that piece of it, either augment it or replace it somehow. And then last thing is private activity bonds. They are cap limited. So we need to increase the caps on the private activity bonds in order to make them more effective and efficient for folks. So those are some of the gaps that at least last week, the folks who testified in Washington, D.C. identified as challenges.
Can you maybe just speak a little more on the private activity bonds for people who may not be familiar what those are? What role
Well,
they
they're
serve?
bonds that are, they're bonds that are developed and placed, and it allows people to invest in infrastructure.
Great, thank you. So we've talked about some gaps. You start talking about some solutions, David. I can give some perspectives as a private investor. You know, the fragmentation and where we focus our investment on the private side is really those smaller systems that lack access to the type of capital that Tyler can provide. And so what my observation is that the only way to really do that effectively is through consolidation, regionalization of rate structures that mean that those systems that are in more distress, that require an incredible amount of capital per customer, can be consolidated with some larger systems, and then together they can afford to bear those costs together. And we've seen in a number of states some receptivity to that model. They recognize that it just doesn't make sense to have 10,000 tiny utilities in the state. The other thing I think in terms of solution to the funding gap, either it's bring more capital in, or can you do things more efficiently so that you don't need to bring as much capital in? And on the efficiency side, going back to our utility example where we are financing these small systems, we're now doing a lot of things with remote monitoring, which means previously you might have to have someone come out every day, every other day, check on the facility. Now with remote monitoring, which most of these systems don't have, many of them don't even have water meters, you can do that a lot more efficiently and free up your OpEx so that you can invest more CapEx to fix the system. So that's a couple examples from where I sit of where we're seeing both, enabling more capital come in, but also reducing the amount of capital needed by reducing those operating expenses, doing things a little more efficiently. I don't know, Tyler, if you have seen any sort of maybe more innovative solutions or things that are working to kind of plug the hole a little bit.
Yeah, I think one area where I'm spending more and more time, more in Rama's world, on the corporate side actually is, there's an alternative to a public sector entity designing and building a project. The private sector could do that. Now, historically, the cost of capital differential has been so large that it's made more sense for the public sector. It's been more cost effective for the public sector to kind of design, build, construct those projects. And quite frankly, that's a risk that the public sector is pretty well equipped to manage. There's not a ton of technology risk. You have construction risk, but there aren't a lot of kind of risks that the public sector would be needing or looking to transfer to the private sector in return for a potentially higher all-in cost of capital. I think what we're seeing a little more now is smaller projects that are being developed by private sector companies, and looking at, let's just say there's a project for water recovery from oil, and private sector company is going to develop that and enter into a long-term water supply agreement with the municipal water off-taker. That's a structure we can finance. when you put those two pieces together. And so I think we're going to start seeing potentially more of these smaller water supply projects that, taken together, can help augment water supply, and maybe eliminate the need for, another large advanced wastewater treatment facility that's has a much higher capital cost. So, we'll see. I guess it's similar. The analogy would be, distributed generation in the power market. Can you cobble together a handful of smaller projects, privately developed, how you finance that, whether it's, private in the private capital markets, depending on how you structure some of those contracts, you could have access to tax advantaged financing, certainly potentially private activity bonds, although they're volume capped and very difficult to get right now. But I do think that's an emerging kind of theme that I certainly from my seat, I'm seeing more frequently and trying to figure out how to create a structure that is cost effective and maybe eliminates the need for some of the larger capital projects that can't be rate based at this point.
Yeah, we're seeing that on the public side, increasing interest in sort of usage-based kind of infrastructure as a service, for example, where you're not having to over-engineer a project for the next 50 years. You can kind of do it in stages, keep your costs lower as a result, build only what you need, for the next few years, is another thing we've seen. David Palumbo, David Wegner, any thoughts on solutions to bringing more capital or reducing the need?
Go ahead. I can jump in here for just a couple of things that are going on right now. I think one great example is here in the state of Arizona with the state WIFA program. It is kind of a spinoff of the federal program, but I was on a call watching it yesterday, and the types of communities that are bringing projects to the state WIFA program there's a need. They're going out. They're working with the state WIFA program people to find ways to gain access to that funding set aside by the legislature. It's a great example. That's exactly when we set up the federal WIFIA program. That was the intent, is that the states would start to spin off their own programs as well. The other thing that's going on is that I mentioned earlier that I'm on this EPA Environmental Finance Advisory Board. It's looking at rate structure and design. You guys want less risk. In order to have less risk, we've got to make sure that the rate structures, the way the communities are funding these things, reduces risk, so you're more willing to invest in that whole thing. And I see there's a whole realm of technology that's out there. Dr. Megdal here from the Water Resource Research Center down at U of A, she and her students are they're looking at the future. What can we do? Where are the gaps technology-wise? Jay Famiglietti here and his work with the GRACE satellite systems, when he first brought that whole program to Washington and had me take students around and introduce them to folks, there is a tremendous wealth of knowledge that we have in our young people that we need to make sure we nurture, we mentor, we get them in to where they can help make better decisions in the long term.
And you mentioned technology, which I think is really interesting. What any particular technologies you think will help reduce the costs? I think that maybe reuse is one consideration. We have we clean a huge amount of water for potable use that only a fraction of it which is used for potable drinking water. I mean, what else do you see out there?
I can real quickly say I'm also have been on the Water Science Technology Board for the National Academy of Sciences. We've sponsored several conferences on looking at this very issue. Got a big thick book on water reuse and recycling, et cetera. Again, there is technology out there that needs to be nurtured to be developed. The Bureau of Reclamation had years ago a desal plant right down the road here in Yuma. It's now not functioning or operational, but we learned so much from that research that went in there, and you've got to take that research, play it forward to what did we learn in terms of membranes, in terms of recycling water, in terms of taking out constituents. I work a lot on the PFAS issue. And it's an issue of how, it's one of these chemical constituents now that we didn't know we were creating a problem when we made Teflon and that kind of stuff, but now we've got to deal with it. But how do we measure that? How do we then address that issue? And it's going to take technology to solve that. There's water there. It's just we need to learn how to clean it, use it more efficiently, and use it more effectively.
Maybe I'll just jump in real quickly on the technology piece. And again, going back to the supply and demand imbalance that we have, the need for managing our water resources more tightly with less tolerance is more acute than ever. And so technology plays, I think, a very key role there, whether it be innovation in terms of water supply, in terms of augmentation, whether desal or water reuse is key, but also how we manage our reservoirs and our systems. We're investing in airborne snow observations to, as runoff comes down, and when snow starts to melt, we need to understand more precisely when that's going to occur, what the volume is, and so we can dial in our reservoirs to operate more efficiently through what we call forecast-informed reservoir operations. So those types of advancements will only improve the small margin that we have on the tolerance to operate. And so I see that as a key investment opportunity to better manage our systems as a whole.
I can speak to that. I can speak to that real quick. What the Bureau has done and what the Department of Interior did with the river basin studies is exactly where we need to go. Historically, we've looked at managing assets on a case-by-case perspective. We need to look at it as a system. David just mentioned the snow observatory. That work spooled up with some NASA folks and some technology that developed there gives us a better handle on how much water is in that snowpack. Now, it's behaving differently than it historically did. So we need to learn how to manage that and factor it in to our operation models that the Bureau and the other agencies use. The last thing I'll say is there are 26 federal agencies that have water in their mission statements. About 4 of them talk to each other on a consistent basis. We need to do a better job of partnering and coordinating and sharing data and information. I told you I was a data guy. I'm going to keep pushing this. We need to be able to share information and share knowledge more efficiently.
Great, thanks for that insight. I think we're almost at time.